Today, I want to talk about how the shorts are desperate for more cash. They've already borrowed 13 figures in loans from banks, which is over $1 trillion, but it's still not enough. They're raising fees for their customers or investors, desperate to stay afloat. So stay tuned and let's make some money. Before I dive in with the key information, I wanted to announce the Valentine's sale over at the Millionaire Mindset Trading Group. You can currently get 4 weeks for the price of 3 on the monthly membership or $100 off the lifetime membership using code Valentines at checkout. This is the first sale I've done in quite a while, and it's the first ever sale I've done on the lifetime membership. Later in the video, I also wanted to go through today's crazy 700% gainer on BMR or Beamer Imaging. But now I'll dive straight in with the key information. So, you can see from this article it says the US Federal Reserve reported on Friday that US banks crossed the 13-figure threshold in loans outstanding to non-deposit taking financial companies at the end of January. It says these hedge funds, private equity firms, direct lenders and others use the money to leverage investments and increasingly lend it out to a range of risky borrowers that regulators have discouraged banks from lending to directly. And it even says that amount is up 12% in the past year, making it one of banking's fastest growing businesses, when overall loan growth has been sluggish. So this says these hedge funds, private equity firms and direct lenders have now borrowed 13 figures in cash from banks, which is over $1 trillion. And it also says these hedge funds are using these loans to leverage investments. And they're also lending it out to other risky businesses and risky borrowers that regulators have discouraged lending to, aka like those risky short sellers that are desperate for cash. And it seems they're now just trying to borrow more and more and more, borrowing an additional 12% in money over the last year. The rapid rise in loans to these companies has increased because there's very little information or oversight regarding the risks being taken by those groups. As a prime example, Citigroup has recently partnered with an outside alternative investment manager, Lumin Arcs, to provide innovative leverage solutions to its $2 billion loan fund. So Citigroup is trying to find new ways to lend money to hedge funds. In 2010, loans to hedge funds totaled just over $50 billion for the entire banking sector. As I said, that figure is now over $1 trillion. Which again also shows these hedge funds have become more and more risky, taking on more cash and leveraging their investments further. Not just 1, 2 or 3 times leverage, but 7, 10, 15 times leverage or even higher. And speaking of Citigroup, there's now more concern about over-leveraged banks. Kristen tweeted saying US regulators have asked Citigroup directly for urgent changes to the way it measures default risk of its trading partners, and the bank's own auditors have found a plan to improve internal oversight, which is lacking. This article says the US regulators have asked Citigroup for urgent changes to the way it measures default risk of its trading partners. Basically saying that Citigroup is sending out these risky loans and is giving these risky loans to hedge funds, private equity firms and others, but it doesn't calculate default risk very well. In fact, it's taking incredible risks lending to these risky companies. It's basically saying that Citigroup is not appropriately counting the level at which these hedge funds should be margin call, and therefore it's exposing Citigroup to even more risk by not calculating their default point accurately. Because if and when these hedge funds do default, Citigroup will end up taking a massive loss. So these banks are lending more money to risky hedge funds, over $1 trillion now, and they're also not calculating their default points accurately, exposing these banks to bigger losses. It says the regulatory notices come as the bank works through 2 2020 consent orders, in which the Fed and the OCC directed the bank to fix long-standing and widespread deficiencies in its risk management, data governance, and internal controls. I also wanted to go through today's crazy 700% gainer, which was BMR. As you can see, I first alerted it in the pre-market, waiting for the breakout from $4.25. I then alerted it again later in the day, still in the pre-market, ready for the breakout of $6.25. So I gave multiple entry points, waiting for those various different breakouts where the team capitalized as BMR ran from $4.25 up over $30 per share. As you can see from these screenshots, the group absolutely smashed BMR. Repo Man made 600%, taking $500 up to $3,000. Snowbird made $4,000 profits. RJ's made 101% profit. Chris made 140% profit. And Crime Candle made over $7,400 today, tripling his account 2 days in a row. As I said, today is the first day of the Valentine's sale where you can currently get $100 off your lifetime membership or 4 weeks for the price of 3 on the monthly memberships using the code VALENTINES, all in capitals, at checkout, using the link in the description below. Now, Bigums has also tweeted this article about how hedge funds are raising fees for customers and investors despite their poor performance. It says hedge funds in the US have raised the fees they charge to clients to record levels, despite trailing the performance of the stock market over the past year. Basically, hedge funds failed to beat the S&P 500, but as a result are now charging clients new all-time high record fees. Clearly, they're desperate for more loans. They've already taken out over $1 trillion in loans, and they're also desperate for more cash or more fees from their clients. They're desperate for more cash in every angle because these hedge funds are obviously close to going bankrupt. It says the management fees charged by established hedge funds in America rose in 2023 to their highest level since 2012 and are now in record territory. And the reason why these hedge funds are so desperate for cash from all angles is because the Fed, or specifically the SEC, OCC and DTCC, are still raising margin requirements. As Frank has tweeted, they've just changed or increased the volatility haircut schedule, which basically means that securities are now receiving a larger haircut, basically meaning they're going to struggle to meet margin requirements even more. For securities that are maybe worth $500 million towards margin requirements, those securities may now only be worth $450 million, for example. So basically the change that the NSCC are implementing is to increase the haircut rate for lower valued securities. You can see these haircuts are going from percentages like 52% to 57%, 119% to 125%, and 37% to 39%. It's an increase of between 2 and 7% for all securities priced below 1 cent and up to $5 per share. Even shares above $5 per share have also increased that haircut rate, basically meaning that any security in the entire stock market is now worth less for margin requirements. aka proving my point that these banks are struggling to meet margin requirements and are therefore desperately taking out more loans and charging their clients more. Dade Murphy has also tweeted about this new article from Investor Place, who seem to be doing a 180 on meme stocks. Previously, Investor Place has posted articles like AMC stock, the dog with fleas that just won't die. Should you buy? No. Along with countless enter anything here won't save AMC articles. But now, Investor Place has given you 3 meme stocks to buy on the dip in February 2024, AMC, GameStop and Virgin Galactic, saying that GameStop has the right stats to warrant a closer look at its short squeeze potential, and that AMC could rise from pressure applied in the options market. I don't know whether this is an article to try and sucker in additional people into buying call options, or if Investor Place is trying to change their tone before a big AMC run-up. But Practical Stocks has also pointed out the incredible increase in AMC's short interest. I covered this just a few days ago, where it had increased from 23 million to 29 million shorted shares, and now that's at 31 million shorted shares, legally disclosed. In the last 2 weeks, it's increased from 27 million to 31 million, another increase of 14%. And again, as I said, this is just the legally disclosed short interest. Imagine what's happening to these illegal synthetics. If the number of shorted shares over the last month or so has increased from 13 million shares or 15 million shares up to 31 million, it means the synthetics have likely doubled too. Again, just proving even more how stuck these shorts really are. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.